Okay, so welcome to the deep dive, everybody. We're gonna dive into something today. Um, Something that I know is on a lot of our minds. It's these rising interest rates, right? Here in
Mm.
the U.S., we've been digging through some of the latest insights, trying to make sense of it all. We checked out some really interesting conversations on the Financial Pulse podcast and some other spots. Just to really bring you the stuff that really matters. We want to cut through all that financial jargon, all that fog, help you understand like not just what's happening, but what it means for you in your wallet, right?
Yeah, for sure. It's definitely the big talk right now, and for good reason. I think
Hmm.
I think everyone's feeling it.
Yeah.
Feeling a bit of a pinch, or at least they're at least wondering like what these changes mean for their plans.
Yeah, exactly.
So yeah, I think it's great we can unpack this and offer some clarity.
For sure, for sure. You can't open a financial news site these days without
Yeah.
seeing something about it. It's everywhere. And let's be clear, right from the start, right from the get-go, the big reason, the big engine behind all this is the Federal Reserve, the Fed. They're
Hmm.
trying to, wrangle this inflation, that steady creep upwards in the cost of everything and makes your paycheck feel like, it just doesn't stretch as far as it used to. They're using interest rates as, one of their main weapons in this fight.
Exactly. Like, you can almost think of it like the economy. It's been running a little hot,
Yeah.
and the Fed's kind of like gently tapping the brakes by making borrowing a bit pricier.
Mm-hmm.
It's all about like trying to bring things back into balance.
Yeah. Yeah.
Make it a bit more sustainable.
Yeah. Makes sense. So our mission today, it's simple, but it's crucial. We want to get specific, granular almost, about how these rising rates are impacting your personal finances, the stuff you deal with every day. We're going to zoom in on some biggies like mortgages, buying a home. That's huge for so many people. Credit card debt, which can really spiral out of control if you're not careful. And even what's happening with your savings.
Right.
And the most important part, look, we want to give you something you can use, right? Arm you with some concrete steps, actionable stuff you can actually do in response.
Absolutely.
So, okay, let's unpack this. What's the real story, the engine behind these Federal Reserve interest rate hikes? Why are they doing
So
this?
the driving force, as you mentioned, is to get a handle on inflation. When prices for goods and services, when they rise too fast,
Huh?
it erodes your purchasing power, right? Like your money just doesn't go as far. The Federal Reserve, they have this dual mandate, right? It's to maximize employment, keep people working, and then price stability to keep those prices in check. And right now, their focus is laser focused on that second part, on keeping those prices stable. So one of the ways they do this, they raise the federal funds rate. And that's basically the rate at which banks, they lend reserves to each other.
Okay.
Makes borrowing more expensive for the banks. And then those increased costs, they trickle down, ripple through the whole economy, in the form of higher interest rates for everyone, right?
Yeah.
For consumers, for businesses, for you and me.
Yeah, it's like turning up the cost of borrowing
Yeah.
across the board. So if a business wants to, take out a loan, expand, maybe you want to finance a new car, it's going to cost you more now in interest. That higher cost, at least in theory, makes people and companies think twice about borrowing and spending so much. So if overall spending cools down, that reduced demand can take some pressure off those rising prices.
Yeah, exactly.
Yeah.
It's about, influencing that aggregate demand in the economy. By making borrowing more expensive, the Fed's hoping to, reduce overall spending, which should help moderate inflation, right?
Mm.
It's a fundamental tool in their, in their monetary policy toolkit.
So this isn't happening in a vacuum.
No.
These rate hikes have real-world consequences, and one of the places people are really feeling it is housing. Whether you're dreaming of buying your first place or you've got a mortgage, these rising rates, they're shaking things up.
Oh, absolutely. Let's talk about mortgages first, since that's a huge financial consideration for a lot of people. Business. For folks looking to buy, the immediate impact, right? It's those higher mortgage rates. Higher mortgage rate means a higher monthly payment, right? For the same loan amount.
Yeah.
And this can really drastically affect what buyers can afford. And ultimately, whether they can even enter the market.
And the numbers can be pretty eye-opening. I was looking at some analysis on the Financial Pulse, and they were highlighting that just a year ago, you might have been looking at, a significantly lower rate on a 30-year fixed mortgage. And that difference, that could easily be hundreds of dollars more every month.
Right.
That's huge, right? It really changes people's plans. Makes you wonder how many folks are having to, put their home ownership dreams on hold because of this.
Yeah, it's a considerable shift, and it's happening pretty fast.
Mhm.
What's particularly interesting to me is how this hits first-time buyers, right?
Mhm.
They're already dealing with tight budgets, saving for that down payment.
Right.
And then these higher rates just add, another layer of challenge.
And it's not just those trying to buy, right? What about the folks who already own, especially if they've got a mortgage that, changes over time?
Right, right. So homeowners with adjustable rate mortgages,
Mm.
ARMs, they're directly exposed to those rising rates once that initial fixed rate period ends. And when those loans adjust, their monthly payments can go up, sometimes significantly, and depending on how much rates have climbed since they got the loan, it can really strain those household budgets.
So for someone out there who's, actively looking to buy a home right now, what advice are you seeing? What should they be thinking about?
Well, generally, if you're serious about buying,
Yeah.
it might be smart to lock in a fixed rate mortgage
Mm-hmm.
sooner rather than later, because, the trend seems to be, potentially even higher rates down the road,
Mm-hmm.
and a fixed rate gives you some predictability, right? It protects you from those future increases.
Makes a lot of sense. Getting that stability, especially in what's probably your biggest monthly expense. Now, for those who already own and maybe have a mortgage from, a few years back when rates were lower, are there any moves they can make, anything they can do?
Refinancing is definitely worth considering. So even with the recent increases, if rates are still lower than what you're currently paying, refinancing could lower your monthly payments and save you money on interest over time. But, always compare, right? Compare the current rates,
Yeah.
factor in all the closing costs that come with refinancing and see if it actually, makes financial sense for you.
Right. You got to do the math. See if those upfront costs are worth it in the long run.
Exactly.
Okay, let's switch gears a bit. Let's talk about something else that affects a ton of people. Credit card debt. How are these rising rates playing out there?
So higher rates have a very direct and often pretty painful impact on credit card debt, those interest rates on your cards. Usually called the annual percentage rate, or APR. They're typically variable.
Yeah.
They tend to go up right alongside those Fed rate hikes. So if you're carrying a balance, you're going to be paying more in interest. It makes it more expensive to pay off that debt.
Like the cost of carrying that debt just got heavier, right?
Yeah.
So if you're only making those minimum payments, more of your money is going towards interest and less is chipping away at what you actually owe. It can feel like you're just stuck on a treadmill.
Exactly. It can make getting out of debt so much harder. And that's why, with these rising rates, it's more crucial than ever to prioritize paying down those balances as quickly as you can.
So what can people do right now? What are some concrete steps to get a better handle on their credit card debt in this situation?
Well, there's a few strategies. One is to, check out balance transfer credit cards. They often offer a lower APR, sometimes even 0% for a limited time, That gives you a window to really attack that balance without so much interest piling up. Another option is debt consolidation. You could look into a personal loan, which might have a fixed interest rate that's lower than your credit card APRs. It's really about exploring your options and finding ways to lower that interest you're paying.
Smart strategies, trying to outsmart those higher interest rates.
Exactly.
Okay, let's zoom out a bit again. These rising rates, they don't just affect our personal borrowing, right? They have a wider impact on the whole economy. Let's talk about how businesses might be reacting to all of this.
Right. So businesses, just like individuals, they face higher borrowing costs when rates go up. This can affect their plans, right? Whether it's expanding, investing in new equipment, or even their daily operations. So, if they rely on short-term loans. Higher borrowing costs can make them more cautious, a little hesitant to spend and invest.
Yeah, and, we heard on the Financial Pulse that small businesses, they can be especially vulnerable.
Yeah.
They often rely on loans to, to grow their business or even just to handle unexpected challenges. When those loans become more expensive, it can really hinder their ability to, to create jobs, contribute to the local economy. It's a ripple effect. It impacts communities.
For sure. For sure.
Yeah.
Small businesses, they often have tighter margins, right? So it's harder for them to absorb those increased costs compared to the big guys.
Mm-hmm.
So yeah, the local economic impact can be significant.
And what about the stock market? We always hear about how interest rates can influence, how investors are feeling.
Yeah. So Rising rates can definitely spook investors a bit. There's a worry, right, that higher borrowing costs for companies are eventually going to squeeze their profits. Plus, higher rates make those lower risk investments, things like government bonds, a little more attractive compared to stocks. So
Mm-hmm.
some investors might start pulling back from the market, which can contribute to volatility, you know, ups and downs.
Yeah. Yeah. It's all connected, isn't it? The Fed trying to tame inflation by raising rates. And then it impacts how much we pay for our homes, for our credit cards, and even influences the big economic picture and the stock market. But hey, it's not all doom and gloom, right? There's a potential upside for folks who have savings.
Right. That's the silver lining. While higher rates make borrowing more expensive, they also tend to lead to better returns on things like savings accounts and certificates of deposit, CDs, banks and credit unions. They might start offering more competitive interest rates on those deposits to attract and keep those funds.
So for anyone who has, an emergency fund or some other savings tucked away, they might start seeing a little bit more growth in those accounts. It's a small win in all of this. I know I've been meaning to do some shopping around for better rates myself.
Yeah, it's definitely worth doing. Even if it's not a huge increase, every bit helps. Financial experts often, they really recommend making sure your emergency fund, your savings, they're in accounts that offer the best rates. Good time to review your options.
Yeah, good reminder to be proactive. Don't just leave your savings sitting there in a low interest account.
Yeah.
So just to recap, we've talked about how these rising rates affect the big picture, inflation, and then we zoomed in on the impact on mortgages, how it's making buying a home a tougher challenge and potentially increasing payments for some. We talked about the higher cost of carrying credit card debt and some strategies to tackle it head on.
Right.
And we touched on the broader effects on businesses, the stock market, and even that little upside for savings.
Yeah, that's a great overview.
Yeah.
The takeaway is really that, understanding how all of this connects, it gives you the power to make smarter financial decisions.
Absolutely. And to reiterate some of those actionable steps we talked about. If you're in the market for a home, think about locking in that fixed rate now. Got a mortgage with a higher rate? See if refinancing makes sense for you. Credit card debt got you down. Make paying it down a priority and check out those balance transfer offers or consolidation loans. And for your savings, don't be afraid to shop around for those better rates.
Exactly. These are all things you can actually do right now to help navigate this rising rate environment. Being proactive is key.
Yeah. And looking ahead, as we mentioned, the Fed, they're going to be watching that inflation data closely. If it's stubborn, if it doesn't want to come down, we could see even more rate increases down the line.
Right.
But then again, if inflation starts cooling off, the Fed might decide to pause, tap the brakes or even reverse course and lower rates. It's a bit of a waiting game, to be honest.
Yeah, and that uncertainty, it really highlights how important it is to have some flexibility in your financial plans.
Yeah.
We can't predict the future for sure, but, being aware of these different scenarios, it allows you to adapt as things change.
So as you're thinking about your own finances and all of this, consider this. How might these rising interest rates shape your long-term goals? Your retirement plans, your investment strategy. Are you factoring them in? And what other parts of your personal economy, maybe deserve a closer look as these rates keep shifting? It's definitely a time to stay informed, stay engaged. So thanks for taking this deep dive with us today.
Thanks for having me.
We'll see you next time.
See you.